Welcome to the deep dive. Today we are initiating, well, a very focused exploration into a set of rather provocative sources. These detail future investment strategies based on a speculative, high-technology, low-life societal path, what's often termed cyberpunk.
Exactly. And let's be clear, this isn't about enjoying science fiction. Our mission here is quite precise. It's the extraction of potentially actionable intelligence for you, the retail investor. Specifically, those of you focused on income generation and, crucially, long-term capital preservation.
Especially against what feels like a backdrop of increasing volatility and certainly relentless technological acceleration.
And achieving that requires, well, a sharp, precise, almost unsentimental assessment of where concentrated wealth and power might actually reside in the coming decades. We're examining a roadmap here based on current trends identified in the sources, not making wild predictions.
Before we go any further, though, we absolutely must state the Finbot Insights mandate very clearly.
Yes. This analysis is presented strictly for informational purposes. It is not financial advice. We have to stress that. You, as an investor, must conduct your own exhaustive due diligence.
Absolutely. Consult accredited professionals. And please, do not place unwarranted trust in commentary from, well, social media influencers, or frankly, any unverified sources, including this analysis itself. Trust the data you verify.
Mandate established. So let's unpack this cyberpunk premise. The core idea, and you see it in foundational works like Gibson's Neuromancer, it paints a future defined by these monolithic megacorporations.
Right, and AI dominance, pervasive surveillance, and just massive structural wealth disparity.
Yeah.
That stark contrasts the high-tech, low-life dynamic.
And the central argument we're examining from these sources is that current macro trends really do suggest we're moving towards this. Think about the escalating cyber attacks we see constantly.
And the speed of AI development, particularly generative AI, plus the widening economic gaps globally, it feels less like fiction these days.
It does. The sources argue this is an accelerating trajectory, moving from fringe theory to potential reality.
So for the prepared investor, especially the income-focused one looking for resilience, this kind of landscape shifts the focus. It turns certain things into critical, indispensable necessities, not just luxuries.
Precisely. And those necessities create what the sources identify as robust investment opportunities concentrated across 6 specific sectors. We're going to delve into each one.
Let's start with the most immediate battleground, where the conflict is arguably most intense right now.
Yeah.
Cybersecurity. This isn't just defense anymore, is it?
No, it transforms. It becomes the ultimate firewall, yes, but also an essential offensive play in what amounts to a technology arms race.
Explain that more. How does data change in this projected future?
Well, in a hyper-connected, potentially dystopian digital economy, data isn't just information. It becomes the central currency. It's the key asset, which means data breaches. They're not simple theft. They become coordinated acts of economic warfare. Think corporate espionage, state actors, maybe even rogue AIs, and certainly black market net runners.
So cybersecurity shifts from just patching holes to actively fighting back offensively and defensively.
Exactly. It's an essential capability in this escalating tech arms race. And the market acceleration figures, they really back this up quite dramatically.
Give us the numbers.
The global market just for AI deployed in cybersecurity, that was estimated around, what, $25.35 billion in 2024?
Okay, substantial.
But the projections, reliable analysts see that surging to $93 billion by 2030. $93 billion.
Wow. That kind of growth signals, as you said, structural necessity, not just a trend.
It absolutely does. And this surge, it's directly fueled by the evolution of threats. We're talking highly sophisticated, often invisible attacks.
Beyond standard malware.
Oh, far beyond. Think weaponized deepfakes used for market manipulation or character assassination. And then there's the looming structural risk, the big one, of quantum hacks potentially rendering current encryption obsolete.
Which would be catastrophic.
Utterly. So these existential threats, they necessitate real-time predictive defenses integrated across every single layer of infrastructure. That creates guaranteed demand for the best solutions.
Which brings us to specific investment vehicles, focusing on those AI-driven solutions. CrowdStrike, ticker CRWD, comes up frequently in the sources.
Yes, highlighted as a leader in AI-driven endpoint protection. Their Falcon platform uses machine learning for real-time threat neutralization across potentially vast networks.
And that's essential for managing vulnerabilities from the Internet of Things, right? The IoT environment where every device is a potential way in.
Precisely. Every sensor, every connected device becomes a potential entry point for sabotage or surveillance. CrowdStrike aims to manage that sprawling attack surface.
And the financials seem to support their position.
They do. The sources note CrowdStrike saw something like 150% growth in the past year alone.
150%.
Yes, with strong forecasts suggesting around 25% revenue growth in fiscal 2025. For an investor focused on capital preservation, that suggests a company with a strong competitive moat, becoming indispensable for enterprises trying to survive this digital warfare.
Then there's Palo Alto Networks, PANW. How do they fit in?
They're cited for a more holistic approach, integrating AI across entire enterprise networks and cloud infrastructures. Their strategy moves beyond simple perimeter defense.
Towards what? Proactive intelligence.
Exactly, transforming security into proactive intelligence systems. Now, the sources suggest this level of intelligence could, on one hand, power the surveillance economies of megacore, giving them an edge. Or, conversely, it could be the essential infrastructure supporting resistance movements operating against that control. It's a double-edged sword technology.
The market seems to anticipate this dominance, though. The PE ratio is quite high, isn't it? Around 45 forward PE.
It is high, yes. And that signals the market is pricing in substantial continued expansion for years. That's a challenge for traditional value or income investors.
So how do the sources justify that? For an income investor, that valuation looks risky. Is the argument that cybersecurity becomes so critical that normal metrics don't apply?
The argument presented is starkly unsentimental. In this projected future, cybersecurity failure isn't just a setback, it's catastrophic. Immediate economic ruin, corporate takeover. The cost of failure is essentially infinite.
I see.
Therefore, the logic goes, the highest quality, most predictive defense tech commands a premium, almost irrespective of traditional PE ratios. Investing becomes like paying a non-negotiable insurance premium on the future economy itself.
Understanding that premium is crucial then. But diversification still seems wise given how fast threats evolve. The sources mention some ETFs.
Yes, diversification is prudent. 3 specific ETFs are highlighted for varied exposure. First, the global X Cybersecurity ETF, ticker
BUG.
That offers broad exposure over 25 firms. It's a way to tap into that bigger projected $234 billion AI security market by 2032, smoothing out single stock risk.
Makes sense. What's the second?
The first, Trust NASDAQ Cybersecurity ETF, CIBR. This one tends to emphasize innovation more, focusing on threat detection across 30-plus global firms.
And its performance reflects that focus.
It seems so. The sources cited a strong 25% year-to-date return in 2025, suggesting it captures the momentum of that digital arms race quite effectively.
And the third ETF?
That's the Amplify Cybersecurity ETF, HYMTF. Its angle is slightly different, targeting ethical hacking and data privacy plays more specifically.
Interesting niche. How's it performed?
Also strong performance noted, around 23% year-to-date return, apparently benefiting from the rising global regulations around data handling, which forces companies to proactively test their own defenses.
So wrapping up cybersecurity, the main risk identified is potential market overhype, valuation bubbles.
That's the primary near-term risk, yes. But the crucial point from the sources is the continuous, escalating, and structural nature of cyber threats in this projected future. That guarantees sustained, almost non-cyclical demand, mitigating the risk of a long-term collapse for the sector leaders.
Okay. Moving from the digital battlefield then to the physical instruments of control and labor. Section 2, AI and robotics, betting on the machine overlords, as the sources put it rather bluntly.
It is blunt, but it reflects the core investment logic presented. Automation, robotics, AI, they aren't just tools. They form the mechanical heart of this potential cyberpunk economy.
Systematically replacing human labor across the board.
Yes, from heavy industry and logistics, right down to domestic help, companionship bots, even enforcement roles. The stark investment logic favors machine labor over human labor due to cost, consistency, and control.
So macro trades should lean towards
industrials, capital goods manufacturers, and the big tech firms that are essentially bootstrapping these new infrastructure cycles, building the machines and the systems that run them.
The growth projections here are pretty eye-watering, aren't they?
They are staggering. Robotics, specifically, is cited in some sources as potentially yielding 1,000% plus returns over a 5 to 7 year period.
1,000%?
Yes. Positioning it, potentially, to outperform even the broader AI hype by focusing on the physical manifestation, the actual machines doing the work.
And this isn't projected way out in the distant future.
The timeline suggested is accelerating. By 2040, the argument goes, the dominance of this economic shift, machines replacing humans, could become an undeniable reality, which strongly favors getting positioned now, targeting the foundational builders.
Which brings us to NVIDIA. NVDA, still the kingpin.
Absolutely identified as the critical GPU provider. Essential for fueling the AI training, the robotic vision systems, the powerful data centers, basically, the brains and eyes of this entire infrastructure.
Their chips power the neon-lit factories, the autonomous vehicles, maybe even the security drones.
Precisely. It's foundational. And its financial metrics reflect that, which helps justify the high valuation for growth investors. Market cap over $3 trillion now.
And the margins.
Exceptional margins cited, particularly on data center revenue, 80% or even higher. That signifies its indispensable, almost utility-like position at the base layer of this new AI-driven world.
So the capital preservation angle is that owning NVDA is like owning a piece of the essential infrastructure.
That's the argument. It's less a tech stock and more a stake in the utility company powering the entire cyberpunk economy. Demand becomes structural, less tied to short-term cycles.
Beyond the chips, what about the robots themselves? Accessing specific companies can be tricky if they're private.
It can. So indirect exposure is often necessary. Take Boston Dynamics, famous for Atlas and Spot. They're now owned by Hyundai, ticker HYMTF.
So investing in Hyundai gives you a piece of that agile humanoid robotics development, robots for patrols, infrastructure work, gig economy replacements.
That's the idea, yes. Capitalizing on that advanced mobile robotics capability through the parent company.
Any other specific robotics plays mentioned?
An interesting, maybe counterintuitive one is iRobot, ticker IRBT.
The Roomba company, they've struggled recently.
They have. It's currently undervalued, down significantly from its peaks. But the investment thesis here is predictive, looking ahead.
Predicting what?
Predicting a future where these affordable domestic cleaning robots evolve. They become pervasive surveillance drones, low-cost monitoring units inside homes, and dense urban spaces. Basically, automated eyes and ears everywhere.
That's a chilling evolution. This whole theme, the systematic replacement of human labor driving those 1,000% returns, it directly implies mass unemployment and displacement. How does the income investor reconcile the profit motive with that stark reality?
The source's mandate, again, an unsentimental perspective. The core thesis presented is that wealth creation follows power and efficiency. In this scenario, power and efficiency reside with those who own the means of production, the machine labor.
So acknowledge the ethical tension, but follow the capital.
Essentially, yes. The investor must recognize that the returns are, in this model, predicated on this societal upheaval. But the logical, data-driven conclusion within the framework is that machine labor wins, capital consolidates, and you invest accordingly.
Okay. For investors who want exposure but need diversification in this volatile sector, there are ETFs.
Yes, several specialized ones. The ROBO, Global Robotics and Automation ETF, ticker ROBO, offers broad exposure across both AI and physical robotics.
And BOTZ.
The Global X Robotics and Artificial Intelligence ETF, BOTZ. That one targets over 40 companies specifically involved in automation and machine learning. It showed, according to the source, a solid 15% year-to-date return in 2025.
Okay, so if machines are the overlords and the surveillance state is powered by companies like NVIDIA and Palo Alto Networks, where does the underground economy operate? How do you invest in resistance or just assets outside the system?
An excellent question, leading directly to Section 3. Decentralized finance. Blockchain as the engine of the underground, the cypherpunk's weapon.
So in a system dominated by megacore and potentially total surveillance of traditional money, blockchain offers an alternative.
It serves as the counter system. The infrastructure enabling shadow banking, smart contracts for transactions outside official channels, and maybe crucially, decentralized autonomous organizations, DAOs.
DAOs forming alliances outside corporate or state control.
Exactly. Structural alliances operating entirely on the blockchain, beyond easy censorship or shutdown.
But the sources also mention mainstream adoption. Bitcoin treasuries becoming standard corporate practice. That sounds contradictory.
It's a fascinating duality presented. Industry leaders like Adam Back predicting standard corporate Bitcoin treasuries signals huge mainstream buy-in, even institutionalization.
So the tool of rebellion becomes a tool of the establishment too. How does that work? What's the justification for megacore adopting the cypherpunk weapon?
It comes back to capital preservation in a volatile world. For the megacore, Bitcoin's fixed supply and decentralized nature make it potentially the ultimate off-grid, unseizable hedge.
A hedge against what? Hyperinflation, geopolitical chaos, failure of fiat currencies.
All of the above. They adopt it because its value proposition is independent of the very system they dominate. It's a diversification play for them, an insurance policy. For the investor, this institutional demand provides a potential structural price floor.
So the investment focus shouldn't be on speculative tokens, but on utility.
Absolutely. The emphasis for serious investors, according to these sources, must be on commercial crypto, technologies that solve real trillion-dollar problems using scalable, decentralized networks.
Yeah.
Sophisticated AI blockchain hybrids are mentioned, like Bitensor, using decentralized ledgers for AI training, already attracting significant $50 million plus investments. Also, Helium, cited as a utility for building off-grid, peer-to-peer networks. Essential communication infrastructure if the main grid goes down or is compromised.
Okay, so for investment vehicles here, start with the core assets.
Yes. Bitcoin, BTC, and Ethereum, ETH, are positioned as the primary digital stores of value. Given the volatility, dollar cost averaging, DCA, is strongly recommended for building positions and compounding returns.
Bitcoin as digital gold for balance sheets. Ethereum for the smart contract infrastructure.
That's the framing. Bitcoin for institutional holdings, Ethereum as the programmable layer enabling the decentralized economy, including those DAOs and illicit contracts.
What about connecting the blockchain to the real world?
That's where Chainlink, Ellie and Kool comes in. Its Oracle technology is deemed absolutely essential. It bridges external real-world data like housing market data, corporate results, sensor readings onto the blockchain.
Allowing smart contracts to react to real-world events automatically.
Precisely. It's the nervous system connecting the digital decentralized world to messy reality. Indispensable for complex automated agreements.
And for investors wanting a more leveraged Bitcoin play.
MicroStrategy, MSTR, is identified. Through its aggressive, leveraged corporate treasury strategy, it functions almost like a market Bitcoin transformer, offering equity exposure but with significantly higher volatility than holding BTC directly.
And traditional finance is now providing easier access.
Very much so. Institutional exposure is readily available. The iShares Bitcoin Trust ETF, IBIT, is a prime example. Low fees, around 0.25% spot Bitcoin exposure.
And the assets under management are substantial.
Hugely substantial. The sources mentioned over $89 billion in AUM for IBIT alone. $89 billion. That number tells you this isn't fringe anymore. The rebellion is being institutionalized by Wall Street. That transition is key for capital preservation.
Is there broader blockchain exposure available via ETFs?
Yes, the Amplify Transformational Data Sharing ETF, BLOK. It's a dedicated blockchain fund holding over 50 firms involved in distributed ledger tech across various industries. Showed an 18% year-to-date return, reflecting that broad application.
Okay, let's shift focus back to the human element. Section 4, Human Augmentation, Biotech's Chrome Upgrade, as the outline calls it.
Right. This is where the line between natural human and synthetic existence really blurs, fundamentally changing what it means to be human in this environment.
We're talking cyberware, neural implants, advanced prosthetics, synthetic organs.
Exactly. These define the elite human experience in a cyberpunk world. They offer huge advantages, processing speed, physical ability. But they also introduce profound risks.
Such as cyberpsychosis, overload from the tech.
Yes, that's the term used. Risks from brain-machine interface overload, or just the overwhelming sensory input of a hyperconnected reality. Plus, the risk of hacks targeting the implants themselves.
So, biotech firms profit from two angles here.
That's the argument. They profit from the cutting-edge enhancement technologies demanded by the elite to stay competitive, but also from foundational survival necessities.
Like agribiotech for food security in polluted cities.
Precisely. When conventional farming fails due to environmental damage, genetically modified, resilient crops or vat-grown protein become essential for basic survival in the urban sprawl. Biotech serves both the top and, indirectly, the bottom.
Key focus areas mentioned. Neural tech is obviously huge.
Neural technology is paramount. Companies like Neuralink, currently private, so exposure might need monitoring via related entities like Tesla, TSLA, due to potential synergies with robotics like Optimus, represent the absolute bleeding edge of brain-machine interfaces. This offers the ultimate cognitive advantage.
And the sources suggest this creates an unbridgeable divide.
Yes, a stark divide between the enhanced elite and the naturals. But interestingly, this high-stress, high-tech integration also creates a secondary market.
A market for what?
Medical stabilizers, mood regulators, advanced psychotropics, neural stabilization tech to cope with the cyberware side effects or cyberpsychosis. This could be an unusual long-term defensive play within pharma.
What about physical augmentation? Cyber limbs?
Crucial. Firms in orthopedics and neurotech are key. Stryker, SYK is highlighted as a leader here, They already have the Mako Robotics platform for surgical implants.
Which could be scaled up for complex cyberlimb attachment and integration.
Exactly, scaled dramatically to handle sophisticated prosthetics, both for injury replacement and for elective performance enhancement among the elite.
For broader exposure across genomics and biotech, covering both enhancement and survival.
The ARK Genomic Revolution ETF, RKG, is mentioned. It gives exposure to CRISPR, synthetic biology, gene therapies technologies vital for both advanced augmentation and potentially basic survival mechanisms in a harsh environment.
And IBB.
The iShares Biotechnology ETF, IBB, much broader exposure, over 200 biotech innovators. It showed a strong 26% gain over 6 months in the source material, driven by advances in gene editing, which underpins much of this future potential.
There's also XBI for higher risk tolerance.
Yes, the SPDR S&P Biotech ETFs, XBI. It's equal-weighted, focusing on small and mid-cap firms. Higher volatility, but it specifically targets those potentially high-growth augmentation plays. Was noted as rebounding with a 9% YTD return.
We have to pause on the ethics here. The sources acknowledge the tension, investing in tech that enhances the few while potentially exploiting the many who can't afford it.
They do acknowledge it. The inherent ethical conflict is central to the high-tech, low-life premise. Investment requires confronting that tension between enabling elite enhancement and profiting from tech disparity.
But the unsentimental investment conclusion remains.
That necessity drives profit. Whether it's elite dominance tech or basic survival tech for the polluted sprawl, the demand is presented as structurally inelastic. The investment follows that projected demand, regardless of the societal cost outlined.
All right. Section 5 shifts to the physical underpinnings. Sustainable infrastructure powering the sprawl.
Because none of the high-tech works without power and reliable infrastructure. In a future of acid rain, megacities, and geopolitical friction disrupting supply lines, resilient systems are paramount.
Failing grids demand investment in robust energy and foundational infrastructure.
Absolutely. And crucially, the need for rare earth commodities gets amplified massively. These are the essential inputs for the AI data centers, the robotics, the entire tech supply chain. Control over resources becomes critical.
So what are the key energy pillars identified for this future?
First, renewables, but specifically for enabling off-grid resilience. Next Era Energy, NEE, the world's largest renewable producer, is positioned to supply solar and wind for decentralized, self-sufficient power sources essential for escaping a compromised central grid.
But renewables alone might not be enough for the huge data centers.
Likely not, which leads to the second pillar, a nuclear revival. Not giant plants, but small modular reactors, SMRs.
Fueled by uranium producers like Cameco, CCJ.
Exactly. Cameco supplies the fuel for SMRs, which are seen as the cleanish, scalable power backbone needed for the intense, constant energy demands of AI data centers and robotics factories. Think of SMRs as the dedicated power packs for critical infrastructure.
And the market is already reflecting this nuclear angle.
It seems so. The VanEck Uranium and Nuclear ETF, NLR, was noted as being up 30% amid energy crunches, suggesting the market sees nuclear, especially SMRs, as essential for reliable, dense power.
What about those critical rare earth commodities?
Essential inputs. MP Materials, MP, a major U.S.-based rare earth miner, is highlighted. In a future of trade conflicts and resource nationalism, having domestic control over these materials is vital for stabilizing tech supply chains. It's a geopolitical hedge as much as a commodity play.
For broader clean energy exposure via ETFs.
The iShares Global Clean Energy ETF, ICLN, tracks leaders in solar, wind, hydrogen. It reflects the push for localized cleaner power, showing a strong 46% YTD surge in the 2025 clean energy rally mentioned in the source.
And infrastructure isn't just power, it's also basic needs like food.
Absolutely critical. Food security is infrastructure. Investment in vertical farming is mentioned. Think private firms like AeroFarms or relevant ETFs like VDGN. It addresses the essential need for local, reliable food within potentially polluted urban sprawls, cutting reliance on fragile global supply chains.
Okay, final section. Section 6. Tangible assets, the low-life hedge. What does that entail?
This moves beyond high-tech. The Cyberpunk model suggests enduring value in tangible physical assets as the ultimate off-grid survival hedge against systemic failure.
A hedge against fiat collapse or urban decay.
Exactly. The principle is acquiring assets that hold intrinsic value completely independent of the centralized financial system or the whims of digital markets.
Like what specifically?
Land suitable for bunkers, sustainable farming, heirloom seeds that can be replanted, off-grid solar power kits, even strategic holdings in defense stocks, implicitly for personal or community security.
And real estate within the sprawl itself.
Yes, the narrative favors acquiring physical property. either as means to escape poverty or as a direct hedge against the runaway inflation often seen in uncontrolled urban sprawl and scenarios of currency devaluation.
The old maxim still applies. Buy when blood runs in the streets.
That grim maxim is central to this theme. It focuses on consolidating bankrupt assets during systemic crises. For investors with liquidity and patience, it's about picking up distressed assets that even the megacore might initially overlook.
How can retail investors access this consolidation play?
Traditional routes like the Vanguard Real Estate ETF, VNQ, are mentioned. It gives broad exposure to commercial and residential properties, offering yields around 4% plus, which acts as an income stream and a hedge against urban inflation.
So VNQ becomes a bet on corporate consolidation of urban assets as smaller players fail.
That's one interpretation presented, yes. Betting on the established REITs to consolidate holdings during crises. Sources also briefly touch on emerging tokenized properties, projects like Tytoon, offering fractional ownership of, well, dystopian realty.
Okay, let's synthesize all 6 themes quickly for a final overview.
Right. 1. Cybersecurity. Think CrowdStrike, CIBR ETF. Hack-proofing the future, a $93 billion market by 2030. Indispensable.
2. AI and robotics. NVIDIA, BOTZ, ETF. Automating labor, maybe warfare. Potential for a 1,000% plus returns over 5-7 years based on machine efficiency.
3. Blockchain. Bitcoin, Ethereum, maybe IRBT ETF, the infrastructure for decentralized rebellion and a corporate treasury standard against fiat failure.
4. Biotech, ARKG, enabling elite augmentation but also providing essential survival tech like advanced agriculture or medicine in a harsh world.
5. Sustainable infrastructure. NextEra for renewables, Cameco for nuclear fuel, ICLN ETF, powering the resilient grids and AI centers in an infrastructure boom.
6. Tangible assets. Physical land, maybe VNQ ETF, the timeless hedge against system collapse, the off-grid escape plan. So this deep dive really underscores that preparedness could reward the investor focused on income and capital preservation in such a future. But it's clearly not smooth sailing.
Not at all. The environment described is inherently severely volatile. A consistent long-term holding strategy is stressed as mandatory.
And the key risks remain.
Geopolitical tensions disrupting everything, sudden regulatory shifts killing technologies overnight, and the ever-present threat of black swan hacks crippling core infrastructure. Prudence demands long horizons and extreme diversification across these themes.
And the core thesis boils down to wealth being defined less by currency and more by resilience.
Exactly. Foundational survival capability and structural resilience become the ultimate measures of wealth in that scenario.
The sources apparently end with a rather stark warning.
They do. A solemn note. Cherish the current world, it will not last. And a prompt for you, the listener, to fundamentally consider the ethical tightrope, investing in tech that creates massive opportunity for some, while potentially exacerbating exploitation for others.
It's a heavy consideration, and as we conclude this very sharp analysis, we must reiterate the mandatory compliance reminder.
Absolutely essential. This presentation is not financial advice. It cannot be. You must critically question all information, including this analysis, and certainly anything from social media influencers.
Trust only verifiable data and your own exhaustive due diligence. Consult professionals.
And for more precise, sharp, detailed market analyses like this one, and to ensure you catch future deep dives into potentially actionable intelligence, please do remember to click the like button and subscribe to the FinBot Insights channel.